Hello, everyone, and welcome to an exciting session with Yes Securities. At Yes Securities, we don't just facilitate transactions; we enable transformation. Over the last, over the past decade, we have evolved from transactional broker to trusted advisor for both retail and institutional clients. What sets us apart? It's our unwavering commitment to delivering quality financial advice supported by comprehensive research and disciplined investment process. Our flagship offering chlorophyll draws inspiration from essence of greenery, the pigment that fuels plant growth into photosynthesis. Similarly, our research and stock picking strategies breathe life into client portfolio, providing the essential nutrients they need to thrive in a dynamic investment landscape. I am delighted to introduce our esteemed speaker, Mr. Ravindra Bhandari, who brings over 15 years of experience in Indian financial sector. With expertise in investment banking, corporate investor relations, Ravindra's insights are profound and practical. Armed with an MBA in finance, along with prestigious certifications such as CFA and FRM, Ravindra's knowledge is invaluable. Today, he joins us to discuss key sectoral indicators for value creation. Let's warmly welcome Ravindra as we embark on this enlightening exploration together.
Good evening, everyone. Uh, Today, I will be talking about key sectoral monitorables. In few of the flagship sector in India, what are the key monitorables one should keep in mind in terms of value creation whenever you are investing and those things. The first thing before dwelling into the sectoral monitorables, as I always say that the equity investing is very important. Why equity investing is very important in our life? See, if you look around and gauge around, whoever has created a large quantum of wealth, be it India or overseas, all those kind of investors have most probably has been from an equity investing background. If you take the name of Warren Buffett or Rakesh Jujunwala or the likes of that kind of people, the large quantum of wealth creation which has happened over last century in the world of investing worldwide, mostly it has been through a disciplined equity investing. Other kind of investor who had created this disproportionate amount of wealth would be business people. So I would classify even the business people as they are the very long term equity investor in their own companies, and hence the wealth creation in those companies has happened, and the share as part of being the shareholder of this company, as a promoter of that company, you are being rewarded. So again, I want to highlight that if any of us want to leave a large pot of wealth for our next generation, one of the ideal way for wealth creation, if you are investing for a long period of time, then equity is a very critical and important instrument. There are other instrument which comes under asset diversification, but equity always, if you see the journey of global investors, equity has been the focal point, the main area around which the diversification strategy always revolve. Other thing, before entering into the sectors and their monitorables, I would like to throw light upon what are the key broad parameters we consider when we are identifying any kind of investment opportunity. So I would demarcate it in the four bucket. Say any sector which we pick. The first thing we see is what kind of growth potential, what kind of growth the sector has been growing, and what kind of potential it has for a long period of time. So definitely we would like to attach or invest with the sector where we see there is decent amount of outperformance in terms of growth. So if I say a country like India is growing at 6.5-7% real rate of growth, and we add in 4.5-5% kind of inflation, so we reach about 11-12% kind of nominal GDP growth. So when we are looking for equity investing, when we are taking the risk appetite of equity, we are generally interested in the companies which is growing at a few hundred basis point higher than this benchmark rate for the country. So we try to pick up the sector which is growing at a decent higher rate of growth compared to the country. That is the first parameters where we do the filtering. The second comes, uh, within that sector there are whole host of companies we can identify, but we would like to stick with the companies which are able to maintain their market share or gain market share. So the second layer of filtering is, the first layer of the filtering was the sector itself should be growing at the faster rate than the economy, and the companies which are among the probable candidate for the investment, the companies should be growing at a faster rate than the sector itself. So we get our share of outperformance compared to the country's economic growth. Then what we look at, what kind of profitability the company is going to generate when they are going to grow at the faster rate, and whether the profit gets stuck within the business or somewhere else, or it come back to shareholder. When I say this, whether the profit gets stuck within the business or come back to shareholder, what happens sometimes the company is growing very well, the profit of the companies is also growing very well, but what you will see is company always has to feed in fund to achieve that kind of growth. So either it can be a kind of capex or it can be a kind of working capital. Once they try to squeeze the working capital in India, you will see the sales falter. So if the profit has been generated but it is mostly channelized to these avenues, we are bit circumspect about the actual growth potential of the companies. Nothing in the world of investment comes in a black and white shade of area. It's always some element of gray, some element of your judgment is required when you're analyzing things. So when we are analyzing the company is growing at the faster rate, one thing we always consider is what kind of capex is required to maintain this kind of growth, and what kind of working capital which gets stuck within the business to maintain that kind of growth. Sometimes what happens is a business itself is not a very dominant franchise. That business will not sell on its brand alone. In those scenario, what happens, the promoter will push their product and give elongated payment terms to the buyer. What happens in that scenario, your receivable cycle will always increase along with sale, and that eats up to the incremental cash flow which can be generated. So all these things we look in before we take our final call on investment. And the final pillar, as I say, is kind of governance and valuation. Demarcating the two, something like governance is, as the cash flow has been generated by the company, you make your check whether the cash flow return to the shareholder or it gets channelized into something else which is not that beneficial to the shareholder. So something like if the company is consistently increasing some inter party relation, deposit borrowing, something that is increasing, that is one kind of red flag. Whether the promoter salary is increasing at a disproportionate rate compared to the profitability of the company, because as a minority shareholder, what we would like to see is promoter takes money from the business but via dividend, but they don't take a larger share compared to what companies say. Company profit grew 3x, and if the promoter salary is growing 10x, then promoter is taking some kind of larger than the fair share. We would like that 10x to flow to the promoter, but through a minority dividend friendly channel. So those kind of checks and balance we check. Apart from that, we also keep our eye on valuation. Valuation is again very tricky term, and very fluid in current scenario. But I'll give you one broad baseline where you can think about valuation. Two things always consider when you are talking about equity investment in a particular company. What kind of valuation benchmark or the valuation multiple this company has normally been traded in the past, and what kind of overvaluation or undervaluation it enjoyed or experienced among its peers. There can be a shift change scenario where the historical parameters will not work, but this parameters will work about 60, 70, 75%, 80% of the cases. there will be some kind of turnaround story. There these kind of fundamental practice will not work. But otherwise, in a steady growing business, or the business which has been in function for last 20-30 years, may have gone through a dip but recovering. These two valuation parameters will work in your favor. Try to gauge what kind of valuation they used to trade, say 5 year, 10-year average, and what they are trading today. And then also compare what was the valuation multiple for the sector versus this company, and if this company has improved its ranking in the sector. Something like, the company which you are considering was the fourth, fifth largest player in the sector, and in the past 4 5 years they have increased their business volume such that they are first or second position. So the valuation appeal of that company has improved. Something this When you have this kind of objective study with you will not be biased with what you are reading or something which has been on the news. So that way you would be disinfecting your mind in terms of different information which flows your way. Uh, in current market, what happens is, say 15-20 years back, there you have to seek out for information to make your investment thesis. Now seeking out of information is not that difficult. Information comes to you very easily. Okay, I'll also cover few of the aspect which any individual investor can do. Few of the reading material which is available for everyone, so you can go through that. But nowadays it's more of cutting out the noise and filtering the information and making the insight out of that information. Otherwise, many years back, extracting information itself used to be a difficult task. I'm not saying 5 7 years back, but 10 15 years back, you have to work around to get the right information about the companies. And so right now the information is available at a fingertip. Few of the thing which at least if you are doing equity investing on your own you should be doing is, okay, the larger universe you should be covering is listening to companies con call. They are available on YouTube. So every quarter, whenever the company declare their results, they will have a 45 minutes to 1 hour discussion with the analyst. So you will know what are the key issues which is in the mind of analysts and investors uh, at any given point of time. What are the key monitorables, what are the key growth driver of the company, and what are the red flag for the company. So you can have a view. If you are listening to 4 con calls of that company, you will have that view. The second more deeper analysis would be, nowadays research reports are also available at fingertips. Sometimes they are available at free of cost at few of the websites, money control and all. So you can use that. Other thing is going through companies presentation and everything. If you go, one of the widely used website is Screener. If you go to the document section of the Screener, you will see the presentation and transcript, con call records and everything you will find there. Other thing I'll say, this is the least what you can do is, uh, reach out, find out that the credit reports of the company. What happens in a equity research report, normally we write say 50 20 pages, so it is becoming a very lengthy affair for someone who is not day in day out working as an analyst to read that much of material. But credit reports are normally 4 5 pages. They cover the essential element, key strength and weaknesses of the business and the promoter. Least anyone investing by themselves should do is read that 4 5 pages, so you will understand the companies, where what the business they are in, what kind of growth potential they are looking at. So with this backdrop on the overall level, I would like to talk about few of the sectors and few of the monitorables for those sectors which we do while our work of investing, and you can also follow. Uh, for discussion on any of the sectors, the most important for the Indian environment would be banking. Banking covers 27-28% of India's Nifty 50 index. Any of the investment by any of the mutual fund or anyone, the banking is one of the core sector because it considers more than 25% of the overall weights of Nifty 50. If I include the non-lending BFSI companies, something like AMC, life insurance, or NBFC, you will see that that weight still goes even higher. It would be somewhere around 35% plus. So we will talk about the banking sector. What are the most important thing when you are monitoring a banking sector? The business performance of banking sector lies on three pillars. uh, the first and foremost would be the growth potential. What is kind of growth each of the banks which you are analyzing is growing at? What kind of through the cycle asset quality of those banks? When I say asset quality, it would be our GNPA and NPA, gross net non-performing assets, and then net non-performing assets. Say if a bank has given 100 rupees and loan as loan, what percentage of that 100 rupees didn't came back to bank as an interest and principal? That is a kind of benchmark for non-performing assets. So what is the non-performing assets for the bank? Asset quality, we call it in a broader term. And finally, the ROE multiple, what kind of ROE the banks generates. All those detailed analysis which we do for a banking sector, finally we try to analyze on these three broad parameters, whether the growth is strong, whether the asset quality is consistent, and whether the company is able to generate a higher ROE or not. Uh, the problem with the banking sector is, or the beauty of banking or any lending business is, if the momentum is there for the banking sector, all these three parameters will come on a positive terms simultaneously. So whenever you will see, say, an environment like recently where the credit disbursement was very strong on the retail side before RBI came in very strongly, what we saw is there is huge growth. The growth was so strong that RBI came forward and said that we have to lower down some amount of this growth because the sector is getting overheated. So growth was very strong. When the growth is very strong, normally what happens, even if you are having some kind of relaxation in terms of lending, which will result into some kind of asset quality divergence, say later point of time, what happens during the phase of that extraordinary growth, you will see very low problem on the asset quality. The reason is the denominator is growing at such a fast clip that GNPA and NPA, what I told, is a ratio of what percentage of asset is non-performing compared to the total outstanding. If total outstanding is growing at a brisk pace, this ratio will always look subdued. So these two elements always work together, and finally, when all this thing happen, your credit cost of the business is also low when you are growing at a faster rate. What you will see is your ROE is always elevated. So all these three parameters, what I'm trying to explain is, work positively or negatively always simultaneously for a banking sector. Uh, so asset quality goes for a toss once in 3 5 years. Something happens to the sector. What you will see during those time, once you have a problem on the asset quality, you will see that the lenders take a back seat. So your growth stall. First thing is lender would be restrictive in terms of their lending practices, and the growth will come to a much lower pace, and so on and so forth. What that happened, that you have always built in capacity for a very high growth rate. You have opened offices, you have hired people, so your cost of doing business is also very high. Once you scale down that growth, it hit in terms of your profitability, so your ROE also get depressed. So as I was saying, that these three parameters work positively or negatively simultaneously. So this thing you have to keep in mind. How we try to gauge when we are seeing this kind of high growth number. So say any analyst who would be gauging the banking sector, he would be asking for how much of the uh, lending book is seasoned. Say when I say seasoned, that you will not default, any borrower will not default immediately after borrowing. So he will at least have 6 months to 12 months or 18 months kind of time frame, and then business might not work or his situation might have changed, that yield to depletion in performance of asset. So we always ask for how much of the book is seasoned, and then gauge what is the season adjusted non-performing asset, those kind of thing. Again, I come to ROE. We discussed that finally we dwell down to ROE for the business. ROE are also important because globally we have seen that wherever the banks has operate at a higher ROE, they tend to command a premium multiple in valuation. Just to explain in a very crude way, what's the relation of ROE and valuation multiple? Say in India, we have our government bond GSEC trades about 7.2%. The 10-year GSEC bond trade about 7.15, 7.2%. So if your return expectation is that 7 and 7.2, you are ready to pay one time book value. You purchase the bond of 1,000 rupees, the GSEC bond, and you are every month you are getting that 70 rupees. Every year you are getting that 70 rupees as interest. You paid one time of the book value. The book value was 1,000. The valuation was also 1,000. Now come to the some kind of equity component where the book value for the bank, you will always see that bank also reports their book value per share. So if the book value is say 200 rupees for any particular bank, and they are generating 14, 15% kind of ROE, on 200 rupees book value, the bank is generating 30 rupees every year. So compared to 7%, where if other guys, the GSEC is generating 7 rupees on 200 book value, you would be generating that 14, 15. Right now, you are generating that 2x of the your baseline assumption of the ROE, which is the government bond. So if you are generating twice the return on in terms of ROE for investing in the bank, that sets you what kind of valuation premium also you should assign to. That is one baseline understanding. On top of that, what we see is how this higher 2x of the ROE is being generated. Is it faster growth? The faster growth is temporary or not? Whether it will lead to incremental ROE generation or not? Whether the asset quality is something like which is less secured. Something like, when I say less secured, the retail, as we are reading nowadays, the retail unsecured lending is being very high in the banking sector. The secure part is something like mortgage. Mortgage is considered to be a very, very secured kind of instrument. If you have higher percentage of mortgage, because there the understanding in the Indian market is the default and loss after default would be very, very small. To put it in a very crude way, something like if you have purchased a house of 1 crore, what happens there, that you put in an equity of 10, 15 lakhs minimum, and bank give you a loan of 85 lakhs. Within 2-3 years, what will happen, that 85 lakhs loan will become to 70-75 lakhs, and the property value, which was 1 crore, will go to 1.1, 1.2 crore. So loan to value of the property, the ratio diminishes very fast. So the risk for any lender for the mortgage is considered very low in India. And that is one reason why RBI also asks to keep a very low risk weight if you are offering loan on the mortgage side. Other thing, this thing is less prevalent among the domestic institutional investors, but larger on the foreign institutional investor. They very narrowly gauge what is the NIM profile of the bank. As we have seen in the recent episode in HDFC, when HDFC Limited was merged with HDFC Bank, there was compression of NIM of the bank. The reason is HDFC operate in a mortgage segment where the NIM itself was pretty low, because the risk also profile of the mortgage segment is very low. When the weighted average of the mortgage and the bank loan was taken, the risk, this NIM for HDFC Bank came down from 4.1% to somewhere around 3.4%, I guess. So every quarter you will hear analysts asking about trajectory for this NIM profile to move back to 3.6, 3.7%. That analyst is looking for that 20, 30 bips increment in NIM. Normally, one benchmark rule also which industry follows is, if you have a very high NIM profile, at least for the banking, if you talk about the top 4 5 banks, private banks of the country, when you are valuing, you see what is the NIM profile or trajectory for the banks, and then you put the valuation, price to book value multiple. So higher the NIM profile, the higher the valuation this bank will command. So these are the element which are important. Other thing, bank one thing which has happened in the last 10 15 years is, bank has become, because earlier there was value for reach, there was value for what kind of lending practices which you are doing. The value of reach for the bank is getting diminished, as we speak nowadays, that banking is becoming more and more commodity kind of product. Having a very large physical network is no longer a prerequisite for growth. What you need nowadays is, say, to achieve that higher deposit, to mobilize that higher deposit, you will need a bank branch in a major residential pocket of the city, but you will not need a 3,000 square feet branch with equipped with 15 20 people. What you would need is a small 500 700 square feet branch equipped with 7 8 people. There would be a teller. If you have any issues with the bank, then you visit there. But having a physical presence for this bank helps them in terms of mobilizing the CASA and the deposit. As we are witnessing nowadays, every bank is struggling in terms of mobilizing CASA. One or two banks are doing well. I believe they will come out very well, and the analysts will also reward them. Otherwise, the normal tendency, why this is happening, of lower CASA in India is because the saving tendency somehow has been broken. What India used to experience for 20 30 years, now the mindset has been changing, at least for the youth. It has been changing remarkably, that they will earn and they will spend with the equal vigor. While the previous generation, they wanted to save a large proportion of their earning, and as a result of that, what we see when RBI reports every year in their annual report, they say that the household saving rate is considerably coming down every year. And last year, I guess, we reported somewhere around the lowest level of last 30 years. So these are the, I would like to say, these are the key monitorables when you look for the banking sector. The growth will be funneled by what kind of, for bank, the deposit and CASA is the raw material. So the more quality raw material you can procure from the market, when I say quality raw material, you should be able to procure this CASA and deposit at a cheaper rate. So you are able to procure a quality raw material, then you would be able to service the quality customer because quality customer will ask for a lower rate. What happens when your raw material itself is expensive, you are giving 200 300 bips higher than what the market practice is to garner that kind of CASA and deposit. What will happen? You can't service that first level customer, because he always asks for competitive rate. To make your NIM, to make the similar kind of profitability, you will go to a bit of the risky side of the customer. So having this stable and retail CASA and not CASA, SA and retail deposit helps in terms of bringing down the cost for money within the bank. So these are broadly the parameters one should be looking when you are investing in the bank. On a broader level, you should have a view on the growth of the bank. You should have a view on the asset quality and the improvement or otherwise of the ROE profile of the bank. On these three broad parameters, you can list down 20 other parameters under these three broad heads, and make a investment case for the banking sector. This other thing, which we can discuss, the second largest segment in Nifty 50 constituents is our IT sector. Indian IT sector is prominently a service-oriented IT sector. We don't have a very large product-wise companies in India. There are few. We also own one in our portfolio, but broadly, if I look at Indian IT sector is service oriented IT sector. When you look at the service oriented IT sector, you will find that 50, 55, 60, even sometimes 60% of the revenue of that IT services companies goes in terms of employee expenditure. So that way, I am saying that we are IT services rather than IT product companies. You will see that they have a very high operating profit. One of the companies which we have in our portfolio, their profitability would be operating margin is about 45-50%, where the spectrum of Indian large IT companies is TCS would be highest at 24-25, and rest would be little lower than that. So what I'm trying to say is, whenever you're looking at, say, IT services sector, what are the broad things I would say one should consider is what kind of growth trajectory the company is guiding. The first and foremost thing is what kind of dollar growth guidance the company is providing. Why this is very critical? Say one important aspect of Indian market was, say the dollar growth guidance was maybe in single digit, but we always have rupee to be depreciated by 5-6% every year. What it does, it helps IT companies in terms of maintaining their margin, because the employee, which is about 50-60% of the cost of the business, they have to be given a decent salary hike every year to have them to have them stay longer. If you are not having that support of INR rupee depreciation of that 5-6%, you would not be able to give that kind of wage hike to your employees. So first thing is, what I was saying is, what kind of dollar guidance, because that is the base with which we start our assumption and everything. Even we can take a step back, we can think about what kind of growth projectile growth guidance the developed market is talking about. Why this is critical? Because most of the customers of our IT services companies comes from overseas, 80-90% of the business from there. One thing which has happened, and it reduce our size of incremental growth, is that earlier, say 10 years, 12 years back, we used to be 45-48% of the global outsourcing market. So right now, I guess we have touched about 65-67% already. Bringing incremental market share from that global pot would be difficult, because we have already traversed from 45% to 66-67%. When this kind of scenario happen, plus what I was saying about the developed market growth, because 80-90% of the business comes from there. What happens if the US is growing at 4-5, so they don't grow at, but a real, if they are growing at 3% plus, what happens that if that larger market is growing 3% plus, there will be showering of growth for all kind of IT companies in India. So the large cap will grow, the mid cap will grow, there will be a pocket of small cap which will also find the opportunity, because the pot from where they are extracting the growth is growing at the faster rate. So if they are growing at 3.5% or plus, there will be umpteen opportunity for all hierarchy of the IT companies. When you see restriction in the developed market, basically Europe and US, if they guide for a slower growth than what they used to do 4-5 years, what you will see that the growth will be limited for the larger companies and the companies which can innovate faster. The companies which were enjoying growth because the pot was growing at a very faster rate, their appeal itself diminishes. To explain this point further, what happens? Say if you let talk about only about the domestic market. Something like, if Indian economy grows at 7-8%, which it did in the phase of 2005 to 2007 and 2008 also for some point of time. What happens if you are growing, if the country is growing 8% or plus, there is a larger pot available for MSME, small business owner in the country. So everyone get their fair share to participate in terms of growth. But if the growth of the country in a country like India falls to 4.5%, there will be a growth which will be concentrated on the larger franchise only. So something like HUL, Nestle, who have the financial might, who has the management bandwidth, who has the distribution channel, they will take larger share of this 4.5% growth compared to when the country is growing at 8%. Then you will have a wider participation. This happens, this kind of growth distribution happens everywhere. So if you even if you talk about any company itself, if the company is growing their revenue at a very faster clip, all level of employees are rewarded handsomely. But if the growth stagnates, then the junior most level employee will not get that kind of higher increment. Just to give an example, so the growth also, there is hierarchy. If the growth is in abundance, it will flow to the bottom. If the growth is restrictive, someone who is at the top will garner the larger share of the growth. Other thing which is very critical in IT companies is one thing which they say about the growth guidance. Other thing is how they are maintaining their profitability profile. They don't change too much in a short span of time. They might change on a longer span of time. But IT services, if you see what the margin profile of a particular company has been, you take any of the large IT companies in the Nifty 50, they have been fairly stable. So you see what guidance, improvement, or stability to the already existing business the company is guiding for. Uh, what happens when we assign any kind of valuation multiple? Why this operating margin is a very critical. The growth is critical, and operating margin is also very critical. Suppose there is three level of hierarchy. A company is operating at 15% operating profit, another company is operating at 20% operating profit, and other is at 25%. If there is some kind of increase in, say post COVID, there is very large increase in travel expenditure as a person bring the business on board. What happens? The person who is already operating at 15% margin, his sacrifice of profitability will be significantly higher than the person operating at 25% margin. So on a steady state, when we see business, we see whether how much hit a person with a 25% operating margin is able to take versus what the person at 10-15%. Another side of the story is when the 10% guy or a 15% guy transfers, move towards 15-20%. So then there is a change in terms of rating, that your profile was this one, but now you are migrating and improving yourself. But that's a different story. But on a steady state basis, we see what kind of guidance the companies are providing in their analyst discussion, what kind of margin guidance they are providing. Then we backtrack and check how much is their lever in terms of any kind of bench strength. If the company is operating with a very high bench strength, and they convey that we will be able to improve our margin because of this reason, then there is a reasonable case they would be able to do it. Similarly, if they normally, what happens is 5:1 kind of ratio for onshore offshore, sorry, offshore onshore. So 80-85% would be people based in India, and 15 or percent or so something in marketing and core function will be based on site. So if there is some bit of disproportionate change recently because of project or something in this ratio of onshore offshore, we track whether this will again move back to normalcy, and it will lead to improvement in kind of margin. Otherwise, understanding IT services kind of business, is fairly simple. The reason is there is hardly any kind of capital required. There's hardly uh, working capital which is stuck, because you don't carry any kind in a services business, you don't carry inventory. The cash conversion, if you pick the large 10, 15, 10 companies in India, the profitability which has been made by the company get easily converted into cash. So they, and in last 15, 20 years, they've proven that whatever cash they generate actually moves back to shareholders. So the governance standard is also very high. Then you see somewhat that there is one or two companies which give lofty guidance, but they fail to deliver those. Then whenever you are hearing that kind of guidance for those particular companies, you discount whatever growth expectation you would be having with those companies. And then again, the same way we discuss about the banking sector, you will see what kind of valuation this IT companies has traded at in their historical period, 5 year, 10 year average, and what kind of valuation premium or discount they have traded among the bunch of 5, 7 companies in their group. So if it's a large cap, you compare it with large cap. If it's a small cap, you compare it with the small cap. That way, you can frame your thesis of investment in IT companies. Otherwise, you will always, there would be the thing is, this sector gives tremendous opportunities in bits and pieces. As we say that you will make the maximum return when the fear within the sector has been very high. So if you remember, the fear has been very high at the time of COVID. COVID was a completely exception period. There was complete fear. The valuation re-rated at least 30-40%. That thing we haven't seen yet in the market, at least in last 1 year, when we are talking about AI and those things disrupting the sector. We are not seeing that kind of disruption in the valuation multiple. If we experience that kind of disruption, then we will go overboard and allocate much higher percentage to IT. But that thing in terms of valuation is not that much uh, appealing right now. So broadly, these are the themes. If you are considering IT services sector in India, you should keep in mind. Other thing, the safety net of IT companies is the governance practice. Most of them, if you compare with the largest spectrum of companies in India, they are fairly well governed. The cash conversion has been very healthy. And whatever cash they generate, they keep a certain amount as a percentage of the sheet as a cash reserve in the company, and rest they try to distribute. So that way, it is one of the cleanest, I would say, sector in India. I'll talk about one or two more sector. Then I think we can open for questions, so that in case you want to have any question or convey anything, you can write down on the chat box. Uh, the other large sector in India is automobile. Automobile is about 7.5% of India's GDP. So, what are the broad things one should look at when you're talking about automobile? The first and foremost, which comes to any analyst's mind, is again the growth. Equity is all about growth. Equity capital gravitates towards where the growth is. So, when we are gauging growth, what parameters we take is what kind of penetration level is there in India, and what kind of penetration level we can compare ourselves with similar economy. It will be wrong if we compare ourselves with the very developed countries, because something like if India have a 40 to 1000 ratio of penetration in terms of four wheeler, the developed nations would be 700, 600 plus. So it would be faulty to compare ourselves with those directly with those developed nations. But there are good number of Southeast Asian nation where there is a larger penetration of two wheeler. So you can compare Indian market with that kind of country, and see what kind of, say, when you're comparing the car penetration, when you're comparing the two wheeler penetration, what should be the growth expectations from Indian market. Generally, our understanding is in Indian market, the two-wheeler penetration, at least from the penetration side, we are not deeply under-penetrated. I would say we are really fairly penetrated in the Indian market. We sell about 1.5 to 2 crore two-wheeler every year. So 1.5, and if you take a shelf life of at least 10 years, so we have a running inventory of 15-20 crore out of population of 140 crore. The riders would be somewhere around uh, 80-90 crore. So we have a fair penetration. It is not deeply under penetrated like it has been in the personal passenger vehicle segment, the four wheeler, our penetration is very low. We have a long runway for next 20-30 years. I don't know how we will do that, because seeing the congestion in the metros in the country, it seems like we are fairly penetrated in terms of four-wheeler. But see, the Indian penetration is about 4% or 4.5% in terms of four-wheeler. So there is a huge uh, runway for growth in the four-wheeler segment. In two-wheeler, what we gauge is the story is not about penetration, the story is about premiumization. So which of the companies, there are 4 5 companies large listed in the two-wheeler space, which of them is focusing more on the premiumization rather than having more as a commute bike? So that will be able to maintain their market share or grow their market share if there is any kind of disruption which happens. Other thing is in two-wheeler, as an analyst we track, but as an individual investor, I don't think it would be that relevant for you. Is what kind of pipeline of new product launches? Because envy as a human behavior works very well in a two-wheeler and four-wheeler. If you are going to buy a think about, you are going to buy a new car for yourself, you will want something which is different, not something which is owned by 4 5 people in your society. So that way, the automobile company, what they do is they make some kind of facelift, some kind of changes in the vehicle, and that increases the sales for that particular short period of time for 1 2 years. So that way, the automobile company also come up with upgradation. uh, when as an analyst we also track about what is the normal level of inventory maintained in the channel, because sometimes what happens, what we track is the sales from the company, but if the sales is stuck within the channel, the wholesale, the retailer network, then it becomes difficult for incremental sales to come. But overall, for individual investors, I think that would be too much to ask. Broader thing you should have in mind is which companies have a robust pipeline in terms of delivering new launches, and how successful their all the previous launches has been, how successful they have been in able to maintain or garner incremental market share. If I talk about the 4 5 listed two-wheeler, there is one or two companies which comes to my mind. They are always being able to gain market share. So that should, and they are always expensive also. So that should always be in your radar, that okay, these companies are constantly gaining market share. They trade at a premium, but they, how much premium they used to trade at for a 5 year average, how much premium they trade now, and what is the forecast of higher growth they will experience now. So that way you make your case of identifying companies with a ideal risk reward kind of metrics. Other thing which works for automobile is you have a view on what kind of margin these companies are generating. Sometimes margin fluctuate a lot because there is crucial supply of raw material. Metals forms a critical component in the terms of raw material, so their prices fluctuate widely, which they did post COVID, but now they are normalizing. So you have a view on the margin from that angle as well. But otherwise, what the kind of sustainable PE profile of those of individual companies, where they stack in terms of valuation, and what is the guidance henceforward. I actually thought of discussing small of power and infra, but I'll take a pause. We have already spent some good 40 45 minutes I'll let you ask some question. In case you don't have, I'll speak something about power sector. Okay, we'll see if there is a question. I'll speak something about power sector. The reason of covering power sector is this is very hot among the investor mind recently. So what has happened is, uh, say 2005 to 7, 2007, 2008, India invested 2007, 8, 9. India invested very heavily in the power sector. We actually built the capacities which was required for next 10 years. The reason was, there was one or two power companies at that point of time which were able to generate very high profitability, that they were putting in capex, and the profit which was generated from that capex, they are able to meet the capex requirement in 2 3 years time frame. That was one thing. The other thing which was happening, which was a misdoing of the power sector, was there was very low equity participation from power companies. So what has happened during that point of time, suppose there is a power company, they put up a power plant, saying that this power plant cost us 1,000 crore, but lot of them has super high expenses when it came to capex. So their actual equity participation when they're putting the capex was very small, and this was overlooked by our banking sector. That yield, that since the equity component from the promoter was very small, they were not minding to put the capacity which will be required for next 10 years. So or to put it in another way, uh, the for a large period of last 20 25 years, what India experiences negative real interest rate. So inflation used to be very high, about 7 8% or sometimes 10%, uh, and our cost of borrowing for a large capex driven companies used to be 8 8.5 9%. So they used to enjoy a negative real rate of interest. For them, it is cheaper to borrow, put the plant, which plant will function 5 years down the line, because the inflation will take care of the revenue generation from that plant, and they are not paying a real interest rate. Right now, that scenario has changed. Say India experience about 4.5 5%. Our band for inflation is 4 plus minus 2%. So at 5 inflation, the requirement from banking sector is about 8.5%, 9%, or even higher. So we are paying huge amount of real rate of interest if you are putting a capex driven plant. Then what India used to enjoy before, I guess, 2012 13, this was a normal practice, that we had a negative real interest rate. This actually pushed many large companies to put the power plant which was not required at that moment of time. So what happened is, there was some 50 60% growth which experienced in 2005 to 2009, and then there was a dull period for next 8 10 years. What we experience in next 8 10 years is the clearing of the mess created by overcapacity. Now we have reached that stage that our capacity utilization is again back to that 70% mark. Actually, this the core segment of industrial, when I say core segment, it is steel, cement, and power. You should build in capacities once you start going above 70 72%, because it will take 2 years time frame to add any capacity, 1.5 2 years time frame minimum, and by that time you will be 75% plus 76 77%. So you will again, with the additional capacity, you will bring back below 70%. So that kind of matrix is ideal. But because of negative interest rate, what India did was, we built the capacity so such and such that by 2011 12, I think our capacity utilization was below 60%. And then there was cleaning which was done in the power sector, and now we are again witnessing that segment, that we are entering that phase of growth, where capex will be moved in. But this time the banks are very disciplined. There is no reckless lending by the banks. So we have learned our lesson in that way. But we will see a significant increase in capex, uh, primarily for all the three segment, the power, the cement, and the steel. So in all these three segment, what we have seen in 2018 to 2022-23, what has happened? Whatever the non-performing assets they were, or the asset which was held by a weaker company that get acquired by some larger entities. So the larger entities become very large, and they are not very leveraged. So now that cleanup has happened. Now there is a phase of incremental capex. Earlier, the capacity for the country was almost stagnant. There was marginal increase, but more of the non-operating assets which was held by weaker companies which were at the brink of bankruptcy, they were get acquired by a larger companies in their sector. Now that drive is over. Now we will see decent kind of capex which will come in these three segments. uh, as as we were talking about penetration in automobile, the key one few of the key monitorables for power sector would be what is the power per capita intensity in India. India would be something about 1250 units per person, compared to 3000 is the East Asian average, and the developed countries, US and Canada, would be above 8 9000. Canada is, I guess, 12 13,000. So that way we have, if we plot anything on per capita utilization in India, you will find there is a huge growth. But other thing to adjust that matrix is the power generally grows at uh, 1 is to 1 ratio along with GDP. So if the real GDP growth is about 6-7%, the power in the country is expected to grow, until and unless there is a large shift which happens from consumption driven economy to industrial or manufacturing driven economy, which we are seeing a slight nudge in the last 1.5 year. And that is the reason why the power segment was growing at an 8-9% compared to 6% GDP growth. And we believe this will continue for a decent time frame from here itself. These are the things which one should keep in mind. Other thing is, always when you are looking at power companies, look for companies which has the healthy balance sheet, because this is a uh, funding hungry kind of business. All the companies which you will be looking at, they will be having a very large balance sheet. So what kind of debt equity ratios those companies are having, what kind of capacity utilization those companies are having. In case there is low capacity utilization, the largest thermal power company in India, they operate about 65-67% capacity utilization. But then they always operate in this 65, 67, 70 percent capacity utilization. I don't remember in last 7-8 years they surpass above 70. So you can't build in a case of higher capacity utilization if the company hasn't done so. So you see what kind of utilization they are having in the past, and on that basis you build your case. Other thing is, this is since this is a investment heavy business, instead of the P or the book value, ideal way would be valuing the companies on a EV EBITDA basis. But those are on the power side. The thing is bit more technical. So on that side, I would say you get in touch with the advisors. It would be easier that way to understand, because power is, compared to other sectors which we discuss, it's far more technical, and every company in the sector is a different animal. So having a single kind of approach will not work there. So yeah, but, I'm waiting in case anyone has any question. uh, I would be happy to answer. Else, I think we have already spent more than an hour. So, if you have any question, you let me know. We'll try to answer that. Otherwise, we'll discuss other sectors or some other topics in the next session. Okay, I guess that's pretty much. There's no question, so I'll wind up the session. Thanks everyone Thanks everyone for patiently listening to us. Uh, what we are trying to do is every week or every alternate week we try to bring up some interesting topic about fundamental and technical knowledge about investing, and we try to share it with you so that you also, in case you want to do investing on yourself, so you are well equipped with all the arms and ammunition. So that is our endeavor, and more of to connect with our clients and customers. So we will keep on engaging. We will keep on bringing the information. One week we will be covering something on the fundamental side. Other week we will be covering something on the technical side. So thanks everyone. Thanks for patiently listening to me. We'll connect again. Thank you.